So good evening, everyone. I'm Sunayana Ravula. I'm a graduate from Pilani from finance, which I heard is no longer offered, but I did my bachelor's in finance. I'm really thankful today for the opportunity to the BITSAA management department and the BITSAA team to give me an opportunity to share my work in the consumer retail banking space. I hope you find this session informative. So let's get started. So about me, and actually Sharmila has already given you a very good introduction to my educational qualifications and my work experience. I'll touch briefly upon it again. So I have a bachelor's in finance from Pilani and then a master's in finance from RIT New York. And then I did my applied statistics at Penn State. My first job was at TCA Financial Corporation. It's a Midwest bank in Minneapolis. And here I've worked in the treasury department. And that gave me a very good idea of both the assets and the liabilities, basically to understand the balance sheet of a financial institution. And my next job is at MUFG Union Bank. It's a Japanese-based owned company. And the US headquarters is in San Francisco. So here I got an opportunity to do a lot of analytics and both on the asset side of products and the liability side of products of a bank. So I really enjoy my work here because you can actually see the impact of analytics directly on the bottom line of the bank. On a personal note, I live in the beautiful San Francisco Bay Area, and there are many BITSians here. So it's always great to connect with all of them. I enjoy hiking, gardening, and I volunteer also for nonprofits. And you can always reach me via email after the webinar and after the session is done if you want to continue discussion on any of the topics that I present, or if you have any other questions on banking in general. So what is consumer or retail banking? So here, depending on the bank that you work for, it's either called consumer banking or it's also called retail banking. I want to give you an overview today of consumer retail banking, the products that it offers, and then I will go into details about how analytics are applied from the time a loan is booked until the loan leaves the bank. So there are two types of customers that typically a bank gives service to. One is individual customers or households. And the other one is institutional customers. They could be like companies or corporations. So consumer banking typically serves individual customers or households. And that is what we are very familiar with because we do have a lot of products in the bank, right? Things like home loans, vehicle loans, and then deposit products. And the way they service, they use local branches to serve the customers. In some cases, we do have small businesses that fall under consumer banking, but their revenue should be under a certain threshold. Anything above that, above the threshold that is set by the bank, or if it's a company or a corporation, they're served by commercial banking. So these are the typical lending departments in a bank. You have consumer or retail banking, and you have commercial banking. So I'm just sharing you some of the services that are offered by consumer bank, and these are all services that you'll be familiar with. We have the lending services where we have home loans and vehicle loans, credit cards, personal loans, and lines. And then you would be familiar with the deposit services too, where you have all your checking and savings accounts and fixed deposits. And then we have other miscellaneous services that are linked to either lending or deposit, things like debit cards, phone banking services, and obviously insurance options and investments options. And today my focus will be on the lending services, how analytics are applied in management of lending services products. So retail banking is very critical because the way the business model of banking works is the banks take money from the depositors. So whenever depositors put their money in their deposit accounts, the bank actually uses that money to make loans. So they make money based on the difference in the interest income between what they pay to the deposits and the money they earn from their loans. And usually there is something called a reserve ratio. So the Federal Reserve, or in India, it would be the central bank, So they allow only 10% of the deposits should be kept as reserves in case of emergency. Otherwise, they have to circulate the remaining 90% in the form of loans or investments. So what is the goal of the bank, right? It's similar as for any company or corporation. It is basically you have to maximize revenue with minimum risk. And there are many risks that the bank face. So I'll just touch upon the kind of risks that banks face. So you have risks like credit risk, liquidity risk, market risk, and operational risk. These four risks are the main risks that a banking institution face. So what is credit risk? A credit risk is the risk that someone who takes a loan or a borrower, they cannot repay the loan. And the liquidity risk is, let's say there's a little liquidity crunch in the economy. The bank will not be able to pay the depositors their money. So that is liquidity risk. And then you have the market risk, depending on what is going on in the financial markets, the stock markets, the change in interest rates, there is a risk that the bank takes up, that sudden fluctuations in those could affect the balance sheet of the bank. And then you have operational risk. Things could happen such as natural disasters, or there's a failure in systems or processes or things like that, that could potentially create a problem and affect the uh, revenue of the bank. So these are the main risks faced by a bank. There are other risks too, things like compliance risk, where you as a financial institution, you have to comply with certain regulations. And if you do not comply, then you are audited and findings are issued. And then you have reputational risk, and then strategy risk. So those are some other risks that are faced by financial institutions. Today's lecture would be basically focusing on credit risk. I'm going to talk about how is credit risk managed via analytics. So as I mentioned before, what is the objective of lending credit? So the goal is, again, to maximize revenue and with minimum risk. So when we talk about revenue, it's basically the interest income and the fee income, right? So you get interest income from loans, and the customer also pays fees, annual fees, and late charge fee and things like that. That would be the interest income and the fee income combination. And what is the risk that we are talking about? This is a default risk that the consumer cannot pay back in time, or he might actually not pay at all, and the loan will go into a charge-off position. This is the default risk that we are trying to minimize. So how is this done in the bank? So the bank usually has to design a credit policy. This is very critical. A committee is formed and the business units are involved in designing this credit policy. So there are three main questions that the credit policy has to address. So who should receive the money? Who are you going to give a loan to? And how much money should they receive? And then once you lend the money, then how do you manage the credit, right? So let's say the customer starts making late payments. How do you manage that? What kind of a strategy do you have in place to collect the late payments and make sure the loan does not go into a charge-off status? And when I say charge-off, that means the customer cannot make the payments and he tells the bank that you just close the loan. I won't be able to make the payments. That is when it goes into a charge-off status. And after that too, the bank tries to collect the money. It's called recovery process, where it still tries to get as much as possible from the customer. So you have a gross charge-off when it goes first into a charge-off status, and then you have a net charge-off after you account for the recoveries that were collected. So I will touch upon the credit product pipeline. So it gives you an idea of how when a customer comes to the bank to apply for a loan, what stages the application will go through. So we have these four main stages, I should say. So the first stage is underwriting department. So this is where the customer will apply, fill out the loan application and apply for the loan. And the underwriting department is where all the strategy related to when I talked about who should get the credit, how much should the credit be. That's where all the modeling and analysis goes in the underwriting stage. So it could be a manual process or it could be an automated process depending on the bank. But most of the larger banks, it's an automated process. And then you have what is the outcome of this, right? So you have the application, you apply analytics on the application information, and the outcomes are typically either the loan is approved it's declined, or in very few cases, the customer decides to just withdraw the application. And then it goes into the booking stage. Booking stage is all the loans that were approved, they enter the stage where it gets into the booking system with a certain term, maturity, interest rate, etc. And then the loan sits in the servicing system. So this is where it sits for the entire life of the loan until, let's say, it reaches the maturity of the loan at the end of the term, or it could go into the charge off. Let's say if the customer is late on his payments and he says he cannot pay anymore, then the loan enters into charge off status. And once it goes into charge offs, then it goes into the collections department. Where the collections department will have people trying to reach the customer and still collect money in the recovery process. And typically, as soon as a customer starts showing a delinquency or late payments, then the servicing and collections department, they typically work together to address the situation. So the analytics are basically applied in every single stage of this pipeline. So underwriting, servicing, and collections. Booking is a very short stage that's more of a financial analysis rather than a statistical modeling. So today I'm going to touch upon statistical modeling analytics that are applied in the other three stages. So you must have done statistic related courses. Data is basically king in doing any kind of analysis or modeling. So let me touch upon some of the data that we use. So before that, I want to stress that there are three kinds of statistical models that we use in the bank, basically in the consumer banking department. So one is origination models. Origination means when it's underwriting time, right? Or the booking time. Origination is basically booking time. So we use models in that phase. And then we have then we have the behavior models. These are models that are applied during the life of the loan based on the customer behavior. And then we have collections models. How do you prevent a charge off? How do you recognize that a customer might most possibly make a late payment this month? So those are collection models. So I'll touch upon the data that is kind of very critical in building these models and maintaining them. So the first thing is credit bureau data. And this basically gives a complete picture of the consumer's credit history. And when I say credit bureau, it's in India, it would be CRISIL, or I heard TransUnion and Experian, and also in India now. So they generate credit scores for every customer. And these credit bureaus have their own statistical modeling that generates these credit scores. And they're called, here in the US, we have FICO score, Vantage scores. So they are all similar. They follow a similar pattern, like the ranges are from, let's say, 350 to 900 or 950, depending on what kind of score you use. The lower end of the number is basically shows poor credit history, and the higher end is obviously a consumer with a very good credit. And they have information on trades. Trades is nothing but information on other products that the customer carries with other banks. Then we have inquiries. Inquiries are, let's say you go and apply for a car loan or a home loan, right? So the company, the bank will actually pull an inquiry on your credit file from the credit bureau. So typically, if you have many inquiries, that does not reflect very well, because that means this customer is shopping around a lot, and probably he's getting rejected in some places. So he possibly might not have that good of a credit history. So they also report credit bureau, basically data also includes late payments. So how many times a customer has been late on his products, and the history goes back to, actually, depending on the bureau, 5 to 7 years in time. So you can get a count of how many times a customer was 30 days late on his payment, 60, 90, 120, how many accounts were charged off, how many bankruptcies the customer had, etc. So this is credit bureau data, and this is like a very, very critical piece of data that our bank uses when in the underwriting process, and also to build behavior models and collection models. Next, we have the application data. This data is basically whenever you fill out a loan application or application for any other kind of Credit, you have things like demographic data and then family income, your age, residential status, if you own or rent a property or a home, your employment history, property information, financial indicators, how much debt do you carry compared to your income, loan to value data, so how much is a property or your car worth, how much is a loan compared to the value of the property or the car, etc. So this is application data. And then we have behavior data, right? So as I said before, behavior models are based on behavior data, which is the behavior throughout the life of the loan. So when the customer is with us, what is the behavior of the customer? And there are multiple things that you look at in this stage, in this kind of data. So you have transaction history, right? So how many transactions is the customer making? How many deposit transaction he has? What is the average balance of the deposit accounts? How many debits is doing? How many credits the customer does on a monthly basis or a 6-month basis? And how many accounts does he have with the bank apart from this particular account? What other products does he have with the bank? How much of the products that he's using? Let's say you have a credit card account, right? So you want the customer to use a lot of the credit limit. So let's say your credit limit, you're approved for a credit card for 1 lakh rupees and you use 20,000 every month. That means your usage is around 20%. So that's called utilization or usage. So it could be on a credit card, it could be on a line of credit. It depends on what product it is, but that's the terminology that's used. It's usage or utilization. And then your digital banking activity, how many times you visit the branches, how many times you call in to the call center. Then in terms of marketing models, we also have third-party vendors who provide data on how you actually spend your money. What categories do you spend on? Do you eat out in restaurants a lot? Do you go to retail stores and things like that? So all the data is also provided. So these come in use for things like marketing models where you want to offer, let's say, a travel card. You know, this person spends a lot of money traveling. So you could actually do a direct mail offer and say, you know, we have a travel card with our bank. So would you like to apply for it? And then the last piece of data that we use is macroeconomic data, sorry. Yeah, so this is things like, you would be familiar with this again, it's like GDP, interest rates, unemployment rates, etc. How these macro factors could possibly affect consumer usage and also the default probability of the customer. So what is a frequently used target variable in credit scoring, right? So we build a lot of different models, and there is a very commonly used target variable that's basically the number of days delinquent or delinquent days. So it's basically the number of days a customer passed the loan payment date. So this is our very commonly used default variable. So let's say today is April 15th. Let's say the loan is, your EMI is due on April 15th. So today is day 0 of the counter for days past due on the payment. So April 15th is day 0. And then tomorrow, April 16th, if you did not pay, the EMI did not come through, then the counter starts at day 1. And then you have a counter for this going until 120 or 150 or 180, depending on the product. But typically a max would be 120 or 150 days. And then there are different delinquency cycles that are used in the industry. So once a customer reaches day 30, it is said that the customer has reached one cycle of delinquency. And day 60 would be the second cycle. The day 90, he reached the third cycle of delinquency, and day 120, he reached the fourth cycle. And beyond 120 days, the customer typically enters a charge-off process where the collections department has charged off the loan and is actively trying to recover how much ever they can in the recovery, using the recovery process. So here are the cycles listed. So these are the very commonly used terminology again in the banking world. So the first cycle of delinquency, second, third, and 4+ cycles. And then depending on what model you're building, what the objective of the model is, you can define the target variable to be customer who has entered the first cycle of delinquency or 30 days delinquency is basically considered a bad customer. Otherwise, it is a good customer, things like that. So here I'm just sharing a sample of the target variables, right? So you would be familiar with this in your statistics course. So we use a logistic regression model for, I would say, 90% of most of the modeling that is done, because it works very well in a banking scenario where our target is typically a binary variable. So when I say a binary variable, you would know that it just can take two values, right? It could be 0 or 1, yes or no, depending on what the use case is. So in banking, let's say, here I'm showing a binary variable for a low risk customer or a high risk customer. So anyone who's a low risk is a 0. Anyone who's a high risk customer is denoted as a 1 in the target variable. And this is a deposit balance related example. So high risk customer would be a customer, let's say, whose deposit balances dropped by some X% in the last 6 months, right? So that means a customer is moving money out of the bank and it at a high risk of leaving the bank, or attriting, it's called, the terminology is called attriting. And this is a very critical issue because, as I said before, banking, the way the business model is, you use deposits to make loans, and that's how the banking business model works. So you see a customer whose deposit balance is dropping rapidly, then that's something you need to take action on ahead of time. And that's where the statistical modeling will come in, where you can predict ahead of time that this deposit customer most probably is going to move balances out in the next 6 months. So you can design a strategy to address that. Possibly you can call the customer just to check in on him and say, you know what, we have, do you need any other services with the bank? We have these new products, would you like to apply for them, and things like that. Just drop in and check on the customer if he has any plans with the money. And then the next example I'm using is related to late payments. So you have a good, again, it's a binary variable, good account or a bad account. So good customers are all customers who would pay on time, which is ideally that's what we would want, 100% paying on time, but that's not the reality, unfortunately. And then you have a bad account, all customers who pay late or after the payment due date. And this is a very simple example. And as I said before, we would typically use the delinquency cycle. So instead of just saying all customers who pay late, we would say, oh, all customers who pay 30 days past due the payment date, or 60 days, or things like that. Depending on the objective of the model, you define that scope of the time. And then on the right here, I listed some other use cases in the industry. So let's say you have spam detection, right? You can predict if the email is spam or not, or you can predict for credit card, you can predict if a certain credit card transaction is fraud or not. In healthcare, you can predict if the tissue is malignant or benign. Or for a marketing case, let's say you make a direct mail offer, you can predict that will the customer actually buy this product or not. So these are some use cases for binary classification that are used, not just in the banking industry, but overall in business. So the role of business analytics, there are multiple applications of business analytics in banking. I've listed a few here. So in terms of financial analysis, then we can use it to build pricing models for the bank. So for every product, you can decide on an interest rate that needs to be offered, that needs to be optimized basically, because it has to consider the competitor interest rates too. And then in the pricing models, you have things like expected loss that is accounted for to generate the interest rate. And that's again built on business analytics modeling. And then once the product is booked, you also do a lot of portfolio risk monitoring on the product. How is the product performing? How much interest income are we generating? Where are we making losses? Which group of accounts are making losses, and things like that. Today, I won't be touching upon this pricing and portfolio risk monitoring analysis, but I'll be focusing more on the statistical modeling that is used. So in terms of statistical modeling, as I've mentioned before, we have things like decision trees, origination models, behavior models, collection models, marketing models. All these are based on statistics. And then the algorithms that are typically used are, as I mentioned before, it's majority of it would be logistic regression, and then decision trees. And then you do have linear regression, but it's not as much used because it's a continuous variable related, and logistic and decision trees are all related to a target variable that is binary. And that is the most widely used use case in banking in terms of credit risk. And then you also have gradient boosting and random forest algorithm. So this is nothing but an ensemble of decision trees, because in decision trees, it could lead to overfitting. So we resort to gradient boosting and random forest because it takes care of those problems. And then we do clustering, again, for segmentation and profiling, where you do not have a target variable, but you can use clustering algorithms for the software to figure out how do customers form groups within your population. So let's look at the credit risk scorecard, right? This is one of the very, very widely used analytical methodology in a bank or a financial institution. So as I said before, so you do get a credit score from the credit bureau. It could be called FICO, Vantage, and there are different names depending on what credit bureau is generating the score. So a lot of times you could actually, what banks do is we do not rely just on the credit bureau score, but we actually want to build our own custom score. And you do that based on the credit risk scorecard. And there's a very good reason to do that, because when the credit bureaus build their credit score, they're looking at the population, let's say, in the entirety of the US, right? They consider all the states, they consider all the demographics. But let's say your bank is very conservative, and like Union Bank is very conservative in terms of credit. So we typically offer credit to highly qualified or customers with a very good credit history. So in our case, if we just go with the credit bureau generated score, then it might not be entirely accurate. It will give it will give a good idea of the credit history of the customer. But because that credit score was built on a much wider population that might not necessarily fit or conform to Union, like in our case, Union Bank population, it might not be a perfect solution. So a lot of banks, not just Union Bank, but a lot of the big banks, they like to build their own credit scores, and they use it in tandem with the industry generated or the credit bureau generated score. So this is called a scorecard process, and this is a very, very commonly used analytics. That's why I wanted to share this with you, because let's say you join the analytics department in any bank, you would definitely come across a custom scorecard process. So here, what is the goal of the custom scorecard, right? So here you're using a statistical model and you're assigning a risk score, and that will basically forecast the default probability of a new customer. So let's say an application, you get a application for a home loan. So you're looking at that application and saying, and you apply the model, and the model will tell you and that this customer would end up with a custom score of this much. And based on that score, you can decide whether to approve the loan or you decline the loan, or you can say that, you know what, this loan needs additional manual intervention. So we want some people in the underwriting department to take a look at it. So it saves a lot of money because the bank does not have to look at every single application that's coming in. So how does this work? So you look at your historical data, as you would have learned in your statistics course. It's all based off historical data. Your statistical model is based off historical data, and you apply that model on your new customers. So you collect data in step one. You basically collect data on the previous borrowers. In this case, you're looking at going back in time and saying that let's say for a home loan, we have 1,000 applicants, and this is the variables or data on their application. And then at the time they had applied for the loan, this was a credit bureau data. So banks typically purchase the credit bureau data. So they have relationships with all the credit bureaus, and it's a contract between them, and they purchase the credit bureau data from them. And then you do a typical split on the train and test. And this again, you would have learned in the statistical courses, where you have your total data and you split it into two groups. You build the model on a certain set, which is a higher split. So let's say here you build the model on 70% of the data, and you use the rest 30% to actually test the model on. And then you also have out of sample validation that I have not listed here. That is an additional step you can take. But so this is the first step. You collect data, you do a train and test split, and then you create a binary target that is based on their performance. As I said before, a customer could be 30 days late or 60 days late. So here you're trying to say that based on your historical applicants, after we booked their loan, how many of them were late in their payments after the account was opened. So that's how you define the good or bad. And the scope is always, as I mentioned before, how many days the customer was past due over what time period. And then you do data validation on cleansing in step 3. This is a typical step where you look at missing values, outliers, and you clean the data based on that. And then you do a classification of binning. And you can do it manually to get a rough idea. And then you can actually use statistical methodologies to actually bin it to get optimal splits. Then you build a logistic regression model based on the weight of evidence variables generated in step 4. And then you scale the scorecard. Let's say you want the scorecard to range from, as I said, FICO is from 350 to 850. That's how the FICO score is built. You could say, I want the scorecard to range from 400 to 900. It's up to you. You could choose that. You evaluate the scorecard, and then you deploy that scorecard on new applicants. So these are the main steps. I will touch a little bit upon a few of these steps here so you get a good idea. And it might be a little bit in detail, but this is one of the most widely used analytical process in consumer banking. So I wanted to go into a little bit of detail. So this is, let's say, input scorecard inputs is just an example. I used a very, very simple example here. So you have a target variable. Again, it's, let's say in this case, the target variable is bad. The bad is if someone was 30 plus late on their payment, 30 plus days late on their EMI or payment, then that's a bad customer. A good is they were never late or they were less than 30 days late on EMI. And this is the typical application data, let's say, that you could collect, right? The age of the customer or the on the application. It could range from 20 years to 96 years. The income of the applicant, home ownership, is the customer owning or renting a home, number of years he's at the current address, does he carry a credit card, does she own a car, years at the current job. And then you also look at credit bureau data variables. What is the FICO credit score of the customer? How many accounts does he have open that are not late? And then number of times he was 30 days late in the last 12 months. And as I said, this is a very, very, very simplified example. We typically deal with hundreds of variables, and then you use statistical modeling to come to probably, you shouldn't make the model too complicated for a scorecard. So typically you would end up with 10 to 15 variables at the most on the scorecard. So as I said before, I mentioned this is the 4th step where you calculate a weight of evidence to statistic. This is very important step. So you have an independent variable. You would be familiar with the independent and independent variable, right? So here the independent variable is age. So what is the age of the customer? And the attribute is basically the age groups or age ranges. So for each of these age groups, we are calculating a weight of evidence statistic. So why do we need to do this, right? So weight of evidence is basically, it calculates the strength of the attributes. So strength of these age groups in differentiating the good and bad accounts. So let's say we have 1,000 accounts in our historical data. Out of them, we have 116 bads. That means 11.6% of those applicants turned out to be bad customers, so based on historical data. So that means 884 were good customers. So here I'm just showing a distribution, right? So in column F, we are seeing the distribution of accounts between each age group. So customers who were 20 to 39 years, we had 21% of the data in that age group, and so on and so forth. And the similar way, you can do a distribution of the bads. So out of the 116 total bads we had in the population of 1,000 customers, 28.6% happened to be in the age group of 20 to 39 years. So you do that similarly for the other age groups too, and you have a distribution of the goods. And then finally, in the yellow column, we have something called a bad rate. Again, this is a very, very widely used terminology, and it is used for a lot of statistical modeling and financial analysis in the banking world. So bad rate is nothing but it's a proportion of number of bads over the total population in that age group in this case. So one thing you notice here is the bad rate is like 15.6% in the first group. And then as you go down, it's dropping to 5.3. So what does this tell us, right? Right away, it tells you that the 20 to 39-year-old age group has the highest risk, credit risk in terms of bad rate. And this is based on our historical data. And then you calculate the weight of evidence, which is basically a log of the distribution of goods over the distribution of bads. And this is measuring the strength of an attribute, the strength of the age group variables in terms of separating the good and bad accounts. And then I have the IV is called information value. I'll touch upon it in the next slide, and we'll come back to this, how to interpret it. So one thing in the weight of evidence is, so negative values basically indicate that this particular grouping is isolating a higher number of bad accounts. And this is in line with, so you typically you should have business knowledge, and that you will gain over time, that when you see this kind of distribution, okay, does it make sense based on your analysis that you did in other projects and things like that. So here it is showing that the younger age groups present a higher credit risk. And this is the IV statistic, information value. This is basically telling you that it will evaluate the independent variable, which was age before, the overall predictive power. So the significance of that variable in terms of the model, right? So you have different ranges for IV. So if it's less than 0.02, that means there's no point using it. If it's 0.02 to 0.1, it's a weak predictor. 0.1 to 0.3 is a medium predictor. 0.3 to 0.5 is a strong predictor. And if it is more than 0.5, that means something is really wrong, or it's like too good to be true. So you have to go back and check your analysis or modeling to see what's going on with it. So here I have put a sample, let's say, of variables and what their IV values are. So you have the revolving utilization. Remember, I talked about usage, how much of the credit limit that you use. That came in at 1.05. This we would definitely reject because it's more than 0.5, or you should definitely take a look at it again. Does it really make sense? And the other ones are number of times the customer was 90 days late or 30 to 59 days late. The age also came in. So these are strong and medium predictors. The debt to income ratio was a weak predictor. The monthly income was a weak predictor. And the number of real estate loans or lines the customer has, again, is a weak predictor. It's basically unpredictable. So this is, again, information value. It's not complicated. You already have the data in the previous table, right? It is just a difference between the distribution of goods and bads, and that times the weight of evidence here. So 20.3 minus 28.6 times a minus 0.345. You do that for each of these age groups, and you sum it all up, you get a 0.157. So what does this tell you? So this variable has medium predictive power because it's between 0.1 and 0.3. So you could use this. You could use this variable in your to build your scorecard. Again, this is kind of technical, but basically, once you do this process for each independent variable and the groups within that, you actually have to assign a score. So for 20 to, if a customer comes in and their age is 20 to 39 years, what score would you assign? How many points would you assign to that particular customer, right? That is decided in this slide here. And there's a formula for it. It's not complicated, but it just looks little bit many factors going in basically. So so once you have the weight of evidence, you build a logistic regression. And then, as you know, logistic regression has regression coefficients, right? So you take the coefficient times the weight of evidence, and then you have something called a scaling factor. So as I said before, you can decide on what the range of the scorecard should be, 400 to 900, or you could choose that. Typically, you don't start at 0. Typically, banks choose something like a round number like 100, and then you can go all the way up to 1000. And then let me go to the next slide here. So this is the output for a scorecard.
Hi.
So you have your correct.
Hi, Sunayana. Sorry to intervene. I see a few questions popping up in the Slido. So if you want to take them now, or you want to take them towards the end of the session?
It's up to you. What do you prefer?
I see 3 questions. So I can read them out for you.
Sure.
Yeah. So the first question is, in regards to the models used and data parameters considered in credit services, does the models change in the case of NBFCs where risk tolerance might be more?
I do not know what NBFCs are. Can the person expand on that? Because we don't use the terminology here.
I don't see.
So it's non-banking financial institutions?
Yeah, non-banking financial institutions.
I'm not familiar with the non-banking side, but within the banking world, depending on the product and the risk profile that the product presents, so the modeling is definitely different. So let me use an example of credit card, right? A credit card is an unsecured product. So you don't have any collateral compared to a home loan where you're actually, the title of the home loan or the ownership lies with the bank until you repay the home loan. So a credit card statistical model or analytics vary very differently from a home loan. Even though you do use logistic regression, let's say, but the cutoffs that you use to evaluate the model are very different. And that's how it would differ, I would say, differ depending on the risk of the product. So credit card versus an unsecured product versus a secured product. So an unsecured product, there is a higher chance that the customer would actually withdraw let's say for a credit card, right? The customer has an inclination that, I'm going to lose my job probably in the next month. I know I'm going to lose my job. Then I'll be without an income for some time. So the customer might actually start withdrawing a lot of money on the card. That presents a huge risk. So you could build a model to predict that. There are actually models that the banks use to predict the possible max utilization of the card. So that's an unsecured product. So it's a high risk. Versus a home loan, it's a lower risk product, because even if the customer defaults and charges off on the loan, the bank can go and basically sell the property and make money. It still incurs a loss because the process of actually selling the property and having manpower to take care of things, it costs the bank money, but at least you're not losing the entire loan. So if that answers your question, I'm not familiar with the non-banking side of it.
Yeah, thank you. So next question is, what is binning?
Okay, let me go back. So binning is basically where you're grouping your independent variable into different ranges, right? So you can do based on the weight of evidence. So you can do an approximate binning based on your business knowledge. And then you can refine the binning based on the weight of evidence characteristic. So what the binning is doing is basically you're saying that where are your highest number of bads, right? Where's your highest incidence of bad customers? That's what you're trying to achieve through binning or classification. You could also use the word classification. So here, as it's evident, you see a 20 to 39 year age group has the highest amount of bad rate. So as you're going down in these age groups, you see the number of bad keeps decreasing. So that's where the importance of binning comes in, because when you apply it for a scorecard, let's say a customer comes in and he falls into one of these age ranges, based on the scorecard, based on which ranges he falls into, you can assign a certain number of points. So that's what binning is in terms of doing a scorecard in the scorecard process.
Next question is, does analytics also have competitive advantage at the company level for liquidity, operations, and market risks?
Liquidity, yes. Let me see. For market risk, it's a different kind of analytics that is used. It's called net account value analysis. That's typically done in the market risk analysis or valuation is done in the Treasury Department. So that's a different kind of analytics that is used. So it involves statistics too, but it's not this kind of statistics. It's mostly based on forecasting the impact of the market events on the value of your balance sheet. So yes, it does come into a picture there. In terms of liquidity risk, in terms of, let's say, actually, you could possibly predict the fact that you will have more number of depositors wanting to withdraw their money. So the bank should have enough reserves. So what happened in, let's say in COVID times, right? So the customers lost their jobs and they relied more on their savings. So this was very unprecedented because this kind of phenomena did not happen before. So the bank actually started building models to account for such scenarios. So right now, the bank actually has to revamp a lot of statistical models because we have never seen this kind of a period. And all the models in the bank and even for the credit bureau, I mean, none of us have seen this kind of event ever. So all the historical data that the models were built upon did not account for things like that. So in case of liquidity risk, yes, definitely there are models and analytics that are built to take care of times like this. And going forward, actually this period of COVID has to be accounted for in all our future model building. So it's actually a lot of effort that is going into recalibrating all our models to account for scenarios like this. Hopefully something like this does not happen again, but there is a possibility. So by regulations and for the safety of the reserves, we have to account and constantly recalibrate our models if such events keep happening again. Yes.
Yeah. So I would read one more question and then you may go ahead with the session.
Sure.
So the question is, which top corporations in banking sectors use business analytics for their finance related problems?
Oh, I mean, I wouldn't know of any bank that would not use it. Actually, the degree of analytics might vary. So the bigger banks like Union Bank, Bank of America, Wells, and in India, ICICI, and I mean, a lot of the big players have huge analytics departments that deal with all this. I would say things like smaller financial companies or in the US, like credit unions, they might not have as sophisticated models, but they're getting there. But analytics definitely has to be used in all in the banking world. It does not matter the size. It's just the amount of analytics that is used, how sophisticated the models are, and how sophisticated the products are too. And some of these analytics require implementation of huge investments in software systems. So maybe a smaller bank that is starting out might not do that compared to a bigger bank, but it comes into play in every single aspect in the banking world, irrespective of the size. It's just a different form of analytics possible.
Okay. Great. I think we can go ahead with the talk, and the other questions we can take up after some time.
Sure. Okay. So I was looking at the scorecard output, right? And this is again a very, very simple example. You typically would have, again, I said 10 to 15 characteristics or independent variables that the scorecard is built on. So let's say you apply for the loan, for a home loan, let's say, right? And your age is like 35 years. So as I said before, for each of these characteristics and for different bins or attributes, you have scorecard points, and that is based off the formula that you see here. And I will share the presentation later so you can look at it in details. And there's a lot of reading that you could do online too. So this is based on the age characteristic or an independent variable. These are the different bins, and these bins are optimal splits because of software based on the weight of evidence. It has decided that this is the optimal split for the age. And these are the scorecard points that are assigned for. If you're less than 22 years, you get a score of 100 points. And if you're 32 to 37 years, you get a score of 210 points. And one thing that you notice here is as the age is going up, the number of points assigned is going up. So you have a linear relationship, and logistic regression is a linear model, right? So that is why it works. The scorecard process works very well because you actually should see a linear relationship in the scorecard points. And if you do not see, it would be evident in the weight of evidence here. If you do not see a linear relationship, then you have to go and adjust your bins until you see a linear relationship. And it's an interactive process with the software. But most of the softwares do give you an optimal split, but you can always customize it. Let's say here it was based on your data, it says greater than or equal to 80 years. But you right away know you do not want to grant credit for someone who's, let's say, more than 80 years. Then you can manually change that to whatever cutoff you want. So you can implement cutoffs in the scorecard. So the next characteristic is if you own a home or not. If you own a home, you get higher number of points. That is 225 points. If you rent, then you get 110 points. If your income is less than, let's say, $10,000, and you get 120 points. If it is more than $58,000, you can afford more. So you get 260 points. So let's say you apply for a loan. This is your application, right? You have a cutoff score too. So below that score, you would not want to book a loan because a lot of, less than 600 score indicates that you have the highest number of bads less than that. So you don't want to grant an credit to someone who scores less than 600. And this is an arbitrary, and I will share the details on how this is decided in the next few slides. So let's say a new customer, you apply for a loan, your age is 35 years, you're assigned 210 points, you own a home, you get a point, 225 points, and your income is $38,000, so it falls between 36 and 42, you get 220 points. So your total score is 660 points, right? So looking at the score, it's more than the cutoff, and then you decide to grant a loan. This is very important, right? Because instead of looking at every application that comes in manually, if you have a scorecard process in place, then the system can take care of it. All these rules here that you see are entered into the origination system. And then as soon as an application comes in and all the data is entered, it spits out a score, and the system will automatically approve credit or decline the credit. So it saves a lot of operational costs for the bank. And the next thing I want to share is how do you evaluate, right, a scorecard? So this is cumulative badge chart. So you have a scorecard score, let's say it goes from 200 all the way to 1000. Then you rank order. So you sort the data or the accounts from lowest to highest score, and then you divide it into 10 bins. So let's say you have 10,000 accounts and you sort the data from lowest score to highest score, because remember that highest score means a customer is good, or his risk is much less compared to the lower scoring tiers. Then you rank, then you look at for, okay, in the first lowest scoring group or decile, we have 85 bads. That's like 40% of the 700 total bads are in that bin. The second bin, we have 27% of bads, and this is an absolute level. Then you do the cumulative basis, you do the percentage of bads. And then our thing is, if we did not have a scorecard in place or a scorecard model in place, how would you decide, right? Which is your highest or the lowest risk tier? So if you don't have anything in place, what do? You just say, you know what, I'm just going to take these 700 bags and distribute them equally. So each bin will get you like 10% of bags. And then we can see that if you have a scorecard versus if you just do it randomly, what is the lift that you're getting, right? And one thing I want to mention is the blue line here, those basically deciles 1 and 2, you can decide to do your score cutoff here. When I said score of here, when I said the score cutoff is 600, right? So you can decide where you want the cutoff. So let's say you draw the line here. This is where below that you have scores that are 600 and less. Above that is scores that are 601 and more. So this is how you decide on the score cutoff. So some banks that are very conservative would typically do a cutoff here in the top 2 deciles. Some banks that are willing to take on more risk probably would do a cutoff after decile 3, but you wouldn't see cutoffs going all the way to 5 or 6. That typically does not happen. So what does this tell us, right? Let's say you do a score cutoff here. So here you have 2,000 applicants. Out of that, you have 479 bads. And then the remaining are good applicants, right? So 2000 minus 479, they're good applicants. Whatever the difference is, it's basically 16%. So when you do the score cutoff here, you're saying that anyone less than the 600 score, I'm not even going to look at the application. That means you're potentially rejecting some goods too, because not all of them are bads. So, but the way to look at is you're rejecting 16% of your good customers, but at the same time, you're rejecting 68% of your bad customers, which is a huge number. Because of you're deploying the scorecard and the scorecard is working well. By doing a cutoff here, you're already reducing the risk by a lot, because you, the first 2 deciles, you're able to capture 68% of your bads. So that's an important thing to look at when you do the score cutoffs. So you always have the yin and yang, right? You're rejecting goods, but at what cost, right? The cost is that you're also rejecting almost 70% of the bads, which is actually a very good, which indicates that your scorecard model is actually working very well. If you do not see a high percentage here, and if you see a high percentage here somewhere in the bottom, then you would see that, oh, this is not working well because you have more bads or coming into these groups. That means the scorecard is not really working the way it should. It should always, the highest risk should be in the lowest scoring deciles. That's what you need to look for. And this is just a chart of how the previous table by each decile. I'm just comparing. If you didn't have any model in place, you would just put 10% of the bads here. But because you deployed a scorecard, you're actually capturing 40.7% of the bads in the first decile and 28% in the second decile. So out of all our total bads, see, most of them are captured here. And as you keep going down, you see there are hardly any bads in the highest score deciles, which is what you want to see. So you want to see this steep but gradual decrease. You shouldn't see a spike somewhere in between coming up to, like, let's say 10%. That means the scorecard is not doing well. And to the right is just a visual comparison of the cumulative percent of bads, right? So if you do a random selection, 10% in each, in each decile, this would be the line. And then, but if you have a scorecard in place, and I'm just plotting this cumulative column 5, this is the chart that you see. So this is the cumulative percent of BATS going on the y-axis. This is a cumulative percentage of all accounts. So this is the curve that you see. And so let's say you build another scorecard model, because you typically don't build one, you build multiple models, and then you compare those models, and then you pick the best performing. You build another scorecard model, and let's say the curve comes like this. This is actually even better. This is actually performing better than what you built before. So you would go for that. So that way, this cumulative BATS chart is used for comparing between two models, and it also shows you how well you're comparing to a random selection. And this is one more chart that's called lift analytics. So it is telling you out of those 10,000 accounts, how many times is it better to use the model in contrast to not using a model. So this is just a difference, a ratio of the bad rate in each decile versus the overall bad rate. So you have a bad rate of 7%, that is 700 of your 10,000 accounts were bad accounts based on historical data. So you're getting a lift of 4 in the first decile. So in the first decile, you're actually 4 times better using a model versus not using a model. And you have a lift on a cumulative basis, and this is a chart on the right side is showing you a cumulative lift. So these are just how different analytics that are used to evaluate. Okay, now let's come to the use of the scorecard, right? As I said before, you can use a bureau credit score because you're purchasing the data from them. Some very few banks actually, maybe smaller banks, as you mentioned before, in one of the questions, smaller banks, let's say they do not have that much capital to actually build their own scorecard, and they don't have an analytics team in place to do a custom scorecard, right? They will just go with a bureau credit score and say, it captures the risk enough, and that is good for us. And but a lot of banks who can afford to do it, they do build a custom scorecard. So this is a case where the bank is using both because they want to be extra conservative, right? You're saying, I'm going to actually create a matrix. This is the bureau credit score that I got from the bureau. This is on going across, and going down is a custom scorecard. I just built a scorecard and I have a score. The range is from 20 to 1000. And then one more thing I want to point out is when you look at things like super prime, prime, near prime, these are very widely again used terminology. So this is how they group or classify customers. So let's say you have a FICO score, or that's a bureau credit score. If the FICO score ranges from 750 to 850, those are a super prime customers, the lowest risk customers. So you can blindly probably grant credit to these people. So typically they're divided into these categories, right? Prime, near prime, deep subprime, and subprime, nobody goes near them. So then you have your custom scorecard. You can do your own binning for these, and it's dependent upon some analytics and what your business unit decides. And then here what I've done is you see that I've created a matrix. So, and the reason for doing this is you can assign risk tiers, right? So the risk tiers go from 1 to 10. 1 is the lowest risk tier, 10 is the highest risk tier. So if a customer falls in this 10 risk tier, this is a pink shaded tier. So let's say they have a FICO credit score or any other bureau credit score of, let's say, 620 to 679. But in your custom scorecard, they're scoring between 20 and 450, right? So they're the highest risk customer. You are not going to grant credit to them. So you can straight away decline them because based on this matrix, they fall in these highest risk tier of 10. And so the outcomes could be tier 10 straight away decline the applications. Nobody has to look at it. The system will automatically decline because this kind of a matrix these rules are already built into the origination system. Tier 7 to 9, they are super prime on credit score, and they are in custom score too. They're doing okay. They're near prime and prime in custom score. So you can refer to them. They say that, okay, we are not going to decline them, but we'll refer them to additional underwriting. And tiers 1 to 6, right? These are super prime in the bureau credit score, and they're super prime and prime in a custom score. So these you can straight away, you can approve the application. So it's done by the system. Nobody has to manually intervene. So it's straight away approved. So this is one application that you can see by how building a custom scorecard can actually help the bank in avoiding risk. And not only that, it saves a lot of operational costs because the system can take care of it, and you don't need to have manpower to actually sit and underwrite the applications. Shaili, any questions on the scorecard process? Because I'm moving on to behavior model.
Yeah, Sunayana. So yeah, we can take a small pause here and answer some questions.
Okay.
Yeah, so I would read the questions for you. The question is, given the chances of unprecedented events coming up, is the banking sector looking for solutions via simulations? If yes, please describe briefly.
The banking industry has always simulated in a way, but yeah, as the question asked, because of COVID, the simulations have to be very, very different. So, for example, right, like a project that I'm working on right now. So we basically we use a custom score actually that we built within the bank. And we use it to underwrite loans where we say anyone who comes, like a small business who applies for a loan, and up to 250K, we apply the custom scorecard. So before COVID happened, the idea was we want to use that score, the custom scorecard, and expand it to more than $250,000. Maybe we can go up to $1 million of credit, right? So instead of, because right now, if it's more than 250, then you actually look at the paper application, you have an underwriting team actually manually processing it. So our idea was to avoid this manual processing and all that. Seems like the custom score is working well for up to 250. So can we scale it up to, let's say 500 or $1 million? And then COVID hit us. Now we are in a situation where we have to completely change our strategy. So what we are doing right now is we have the vintages, right? We have the bookings and or the performance during the COVID time. So we are going to look at all those customers and do analysis separately on them. And we do not combine it with the pre-COVID groups. So we are going to study as how bad it is, how the bad rates are for this COVID group. And then we are going to look at a complete picture. Okay, if we include the COVID group, can we actually, because for the pre-COVID vintages, it was decided that we can use a custom score for up to $750,000. But if looking at the COVID group, can we actually do that? Probably, most likely, I think we won't be able to do that. Probably we might end at 500 or something, but I didn't do the analysis yet. We'll be doing it in the next like 1 month. So that is how a lot of things are being recalibrated. So for our existing models, we are doing, based on statistical analysis, we are doing overlays. So let's say your score cutoff was at 600. We have been changing the cutoffs, right? So we are saying instead of 600 to be the score cutoffs, to be conservative because of COVID, we are increasing our score cutoff to 675. So that's one thing that banks are implementing. So depending on the situation and how things transition now and how customers or small businesses recover from this whole COVID process, there are definitely a lot of changes and coming up in this 2021 and 2022 to account for such significant events. Yes. Any other question, Shaili?
Yeah. Next question is, does the scorecard vary from bank to bank or vary for different types of loans?
Yes, definitely. So the scorecard varies from bank to bank because each bank has their own profile of customers, right? If they're a super conservative bank, then our our customer profile is very, very different. Like, let's say we just look at prime and super prime. We don't even like consider like near prime, like these 998s, probably we won't even consider. So each bank's population is different. You're serving different market areas, right? Some people are like, some banks are mostly concentrated on the West Coast, some are East Coast, some bigger ones are all over the US. So depending on the region also, the risk varies. So typically every bank will have their own custom scorecard. So that's an algorithm based on the bank's historical applications. And a lot of the big banks do use a custom scorecard. So it's very personal or customized to the bank's portfolio.
Yeah. The next question is, what are the tools or softwares used for business analytics in finance?
So most of the bigger banks use SaaS. It's enterprise-wide software. Some banks use Minitab. Then there are other smaller vendors now, but that are actually very good. There's a vendor called Altair Networks. They have a suite of products called Knowledge Studio that is amazing actually in terms of visual analytics related to statistical modeling. So what happens in statistical modeling is typically when you have to actually show the results to a business unit or upper management, right? They would not know what, let's say, a KS statistic is or what an ROC is. So you have to actually tell your story, what the analysis of the statistical modeling is telling in very, very simple and in a clear way without going into a lot of the details. And you have to create visualizations too that support that, right? SAS actually has come up with a newer visualization software too. But yeah, we use basically SAS, Minitab, Altair systems, and then we use Tableau for visualization mostly. And Excel is always there. I mean, Excel also you can do probably like 50 to 60% of the jobs that can be done in Tableau. But these are the typical softwares. And in terms of languages, I would say the highly critical ones right now, especially if the students are looking into joining fintech companies. And I think you should definitely consider fintech as one of your possible employers because a lot of fintech companies are not as regulated as banking, but they're using a lot of analytics and artificial intelligence to actually grant credit or manage the credit. So it's a very exciting area to work in. And the software that you would, the tools that you would need to, not tools, but you would need to know programming languages like R and Python. Those are the most widely used in these newer fintech companies. In banks, we use a lot of SAS. And all companies, irrespective of the size, use SQL. So SQL querying is highly critical too, because as analysts, typically you have an IT department, but typically you're expected to pull your own data and massage the data to however you want it to be used for modeling. So you can't always rely on someone from the IT group to give you data.
So I have one last question for you. Would a person need to have an educational background in finance to do business analytics in a bank, or would any educational background be all right?
No, I think any educational background would be all right, but you would definitely need to do some statistical courses. And there's a lot of literature available on credit risk scoring, depending on what group you apply to in the bank. But if you want to get into credit risk groups, like the stuff that I've shown you guys today, so you definitely need to have some knowledge about it and you can gain knowledge. But I think the key things would be knowledge of R, Python, and SQL. And it should be doable, even though you don't have a finance undergrad. A lot of MBA, we have a lot of candidates, with the MBA background who join the banks as analysts.
So I don't see any more questions. So maybe you can continue.
Okay, so how are we doing on time, Shaili?
I think
So Sunayana, you can take maybe 10 to 15 minutes.
Okay.
If that is okay, otherwise we can extend.
No, it should be okay, I think. So I spent most of the time on a scorecard application because it's, as I said, very, very widely used. And the other two things that I show are not as detailed. So I should be able to cover it in the next 10 to 15 minutes. So next is behavior model, right? So scorecard is basically an origination model or a model that you build at the loan application or underwriting stage. So behavior model is used when the customer is all the customer you already have the customer with you, and then you're trying to forecast their future behavior. So let's say you have a customer who has a home loan with you, right? So you want to predict that will this customer become late on his payment in the next 12 months? That would be the use case of a behavior model. So you're using past behavior of the customer to forecast future behavior. And again, the main steps, I won't stress too much on this. Again, it's the typical steps that you follow in statistical modeling. You collect the data, but instead of new customers, instead of collecting data at the time of application that was used at scorecard, here we collect data on our current borrowers, right? Or a deposit customers. So you look at the bureau data at the time that at the existing time, and then you look at the payment activity the customer has with the bank. Then you see if the customer has any current relationship other than the home loan that he has. So does he have deposits with the bank? Does he have any other credit card with the bank, any other products? What are the average balances on all the accounts and things like that. So that's all defined as behavior data. And then again, you define a binary target. So it could be let's say in terms of a home loan, you're saying that, okay, a customer is already 5 days late. Remember I showed you the timeline of how the customer can go from 1 day late to all the way to 120 or 180 days. So you're looking at a 5-day late account and you're saying that, okay, will this account reach 30 days late or not? Because as soon as it reaches 30 days, the customer has reached the first cycle of delinquency. So it puts the bank at a high alert, right? Some customers are late. Sometimes they're just habitual late payers, right? They just pay their EMI late for some reason. So if they're constantly 5 days late, it does not really matter. Probably they'll get a late charge fee. But customers who go from 5 days to 30 days, that means, okay, we need to take some action before they hit 30 days. So this model here can predict that, right? At 5 days late, you deploy the model every month for customers who are 5 days late. It can tell you that, okay, it can forecast and predict that out of these, let's say 1,000 customers who are late, 5 days late, 50 of them are going to reach 30 days late. So you better take some action for those customers. Probably you could call them and you could send an email with a reminder for the payment, etc. It depends on what strategy you use. And then let's say another example is if you're a high risk customer, then as I mentioned before, for deposits, right? Your deposits dropped more than 50% in the last 6 months. That means, oh, probably you're going to leave the bank, and that is a high risk customer. You better take some action to retain the customer. Then you do data validation and cleaning and build a logistic regression model, and typically use gradient boosting here. And you can read up on it, but it's a very strong algorithm compared to a typical logistic regression model, because it builds not just one tree, but it builds multiple trees, and the final output is a function of the multiple trees. And this is a very widely used algorithm, not just in banking, but any other AI related fields. The gradient boosting is a very widely used algorithm. And then you validate and you deploy the model on your current borrowers. And once you deploy it, you always have to monitor the model, because you have to make sure the model is performing well. Like in cases of COVID, right? If we use our old models on COVID applicants who applied for loans at the COVID time, then definitely you will see a shift in the behavior. So you always have to monitor the model performance and then recalibrate the model as needed. So here is one example, and I'm not going to go into the details of how the model was built. Like the scorecard was a very detailed example that I gave, but this is just, it will show you the outcome of the model, right? So this is deposits related. So the model basically predicts the probability of customer moving balances out of the bank in the next 6 months. So today, April 15th, you deploy the model. It will say as of April 15th, who are the customers in your deposits portfolio that who are going to move out balances in the next 6 months. And this is a prediction based on behavior data. So the model is looking at how the customer has been performing the last 1, 2, 3, 6 months. And if there are any indicators that will tell that the customer most probably is going to leave the bank. So the outcome of a logistic regression model is always a probability score, right? So it's between 0 and 1. 0 is the lowest probability, 1 is the highest probability of attrition. Attrition means leaving the bank. So why are you building the model? So in this case, you're building the model because you want to retain the deposit customer. The deposits are very, very critical to the bank. Loans are important too because it gives you interest income, but without deposits, you cannot make loans. So always the bank is always trying to get as much deposits as possible. So you want to retain this deposit customers, and you can deploy, as I said before, if you know ahead that this customer at a high risk of leaving, maybe the banker can make a personal call, you can send an email, or so you can deploy different kinds of retention strategies. So I'll just touch upon a few of the sample final variable risks, right? These were the final variables that turned out to be significant in predicting the risk. And here you see something called a variable word that is just telling you the importance of the variable in predicting the probability score the customer would leave the bank. So the first one is number of open deposit accounts, right? The higher is less risk. That means the number of, if the customer has more deposit accounts, then that means he's at a lesser risk, because why would a customer really completely close those accounts and move out? And then the number of months left on the fixed deposit, right? So let's say the fixed deposit is coming up for maturity. So there is a high chance that the customer might take the money and go to some other bank. It could be for interest rate or any other reason. But the closer you are to the fixed deposit maturity, that means it's more risk. So less time, more risk. So the gap between the current interest rate and the consumer's interest rate, the customer's interest rate. So let's say in the market, you're getting a deposit rate of 10%, but the customer is only like 7.5, then that's like a 2.5% gap in the wrong direction, right? So that means a customer would most probably retreat, take the money and move to some other bank. So more gap, higher risk. Days since last contact. Oh, the customer hasn't been in contact with the bank for a longer time. So probably, he's not engaged with the bank as much. So longer time is high risk. How long has been the customer with the bank, right? So the customer has been with the bank longer, let's say 10 years versus a new customer who's been with the bank for, let's say, 1 year. So longer tenure means he's less risk. They would think twice before moving all the relationship out. Number of direct deposits. Direct deposits are like your paycheck, whatever you get from your pay slips, right? They get deposit directly into your account. The more direct deposits, that means it's less risk. And the number of non-deposit accounts. So let's say the customer, instead of just a deposit account, he already has a car loan or a home loan with the bank or some other products with the bank. More the other products, number of other products, lesser the risk of attrition. So I just wanted to give you a flavor of what kind of variables that would show up in a behavior model. And then this is something related to a loan, and I will share the deck so you have a chance to look at it. So this is predicting the probability that a 5-day late account, let's say a home loan account, will become 30 days late. And again, it's a logistic regression. So the outcome is always 0 to 1. So lowest to highest risk of defaulting to 30 days. So again, why are you building this model? So using this model, you can prioritize. So as I said before, let's say you have 1,000 customers who are 5 days late. This model can say that based on the probability, and once you sort the probability from highest to lowest risk, probably you want to target the top 50 instead of calling or reaching out to 1,000 customers, which is a waste of time and money. You would want to call it your highest risk within those 1,000 customers, right? So you can make a collection call to check on the customer, ask them to pay, or you can do resource allocation. This is very critical because instead of having 10 customer service people call all 1,000 people, you can have 2 customer service people call just the top 50. So you're saving a lot of money in the process. So this is a sample final variable list that would come out significant. And these are just like, just a sample. It's not necessarily what always comes up, but some of the common ones, right? Things like when I said you can use a credit bureau data as one of the inputs, like FICO score. The number of collection calls, maybe let's say you have in your records, you see that customer was called many times by the collections department, then obviously is at a higher risk. How long has been the customer with the bank? What we typically see is the longer the customer has been with the bank, they tend to have lesser risk of defaulting and things like that. And I will just mention this. This is something, one of the statistics that we use to evaluate a behavior model is called a KS statistic. And you can read up on it. There's literature on it. And the reason I chose KS statistic is because I used the charts or the tables that I used before in scorecard, and they apply to this one, to the KS statistics, so it's easier to understand. It's basically tells you which score band you have the maximum difference between your cumulative goods and bads. So let's say you have 2,500 customers, you have 255 bads, and again you rank from highest risk to lowest risk. And you see the KS is nothing but it's a difference between absolute value of the difference between cumulative bads and goods. The KS is highest at 53.9 in the third decile. And you always want to see KS, the highest KS in the top deciles, not in the bottom one. That means the model is performing well. And I just plotted the vertical distance, and this is what you see. And if you have the blue line going even steeper, then that's even better. So KS can be used to compare models too, because as I said before, you build multiple models and then you just choose one final model which performs the best. And there are many other evaluation techniques I touched upon, like probably 10% of what we use, but you have the PSI, which is the population stability index, characteristic analysis, vintage, roll rate, misclassification rates, and these are all the different statistics that can be used and many others. So you can find literature on all of these, but these are basically used to evaluate a statistical model, to monitor how the performance, the model is doing over time. And then the last thing I want to share is decision trees is one more algorithm that we use. It's used for classifying the consumers into groups. So you start with the root node. You might have studied this in your statistical courses, but I'll give you a brief overview. So you start with your total customer population in the root node, which is the topmost node, and like a tree branches out, you build out an algorithm where you have splits. Basically, you're taking, let's say, 1,000 customers, you're splitting the customer based on an optimal split. So it's usually always binary partitioning, and each split is based off a rule. So this is called the root node. These are all the child nodes, and the ones in the bottommost, these are all called terminal nodes. So if you add up all the number of customers or cases in the terminal nodes, it always adds up to the number of cases in the root node. So as I said before, the path through the tree is governed by the answers or questions or rules, and these are all also called decision rules. It's always a binary partitioning. The problem with if it's more than binary is, let's say you have 3 splits, then you can imagine it, the tree actually grows to like hundreds of nodes, and then it's prone to come back to this. So if you have 3 splits, the possibilities are endless. So usually the optimal splits are always binary in a decision tree. So it's a very, very simple example of a decision tree. So let's say, and the definition is also like pretty simple. You have 1,000 customers. A good customer, they were never late on their EMI. A bad customer is someone who was late on their EMI, right? So you have 1,000 total customers. Out of them, You have 900 good customers and 1,100 bad customers. Your event rate, basically this is called event rate. In our case, the bad rate also, the same as bad rate, it's 10%. This is a root node. And then you have the first split. So it's saying, okay, is the customer out of these 1,000 customers who is renting versus not renting? If the customer is renting, the decision tree pushes those customers to the left. So we have 200 people who are renting a home and 800 who are homeowners. So this is the first split. And the next split is on the variable of the people who are renting. Do the customers have a credit card or not? If they do not have a credit card, then out of 200 cases, we have customers who are 50 customers who do not own a credit card. This is the node that they fall in. And if you notice here, the event rate or the bad rate is 40%. That is like 4 times more than our overall bad rate. And if you go to the right, okay, these people are homeowners. 800 people of the 1,000 customers are homeowners. And you're splitting on the variable, they have a credit card or not. If they have a credit card, then you move to the right. So usually the way the splits are, if it's a yes and no split, all the yeses go to the right, the no's go to the left. There's a certain structure to the decision tree. So if you're a homeowner, you have a credit card, and the next split is on age. If you're between ages 30 and 39, you see the bad rate is at 25%. So what is this telling you, right? Let's say you want to apply, again, this is a very, very, very simple example. But let's say you want to apply this decision tree and say, I want to probably do a direct mail offer, right? I want to send an offer to the customers by mail, a letter to the customers by mail saying that, oh, we have this credit card offer. Do you want to apply for this credit card? So how do you choose? You could choose, you could actually deploy a decision tree to do that. So you want to say that, okay, if I want to send it to only people you know are at very low risk of being late on the EMI. So you could use this decision tree. You could say that, oh, if I want to make a credit card, the direct mail offer, I'm not going to go to these nodes like this 25% and 40% because they're much higher than my root node. I'm not going to go after those customers. I'm going to probably go after this customer here, who they're homeowners, but they don't have a credit card. Or I would go for a homeowner who has a credit card, but who's not between age groups 30 and 39, because they present a lower risk compared to these terminal nodes. So there's a lot of interactive, how should I say, back and forth that happens between the analyst and the software, because this is a very simple example, as I said, you don't want to end up with, let's say, 40 accounts. Let's say you have 100,000 customers in the root node. You can actually specify limits that you want a minimum number of cases to be a certain percent in the terminal nodes. Because only then you can deploy it, right? You can't base your decision based on, let's say, 10 accounts in the terminal node. That won't work. And usually a decision tree is like very large. So the software will build out a huge tree and then it will prune it to get you to an optimal tree where you have good splits and you have a good number of cases in the terminal nodes. And decision trees might lead to overfitting. It depends on the use case. So, and you also break out the decision trees into training, holdout, and testing samples. And then usually use a bagging algorithm. That's algorithm that is used. Again, that's instead of building just one tree, because in this case, this whole tree is one single model. Instead of doing that, you can do a bagging algorithm where you actually build hundreds of trees, but smaller ones, right? So you take a subsample of the data with replacement, and you build multiple trees, and then the final solution would be based on, depending on what algorithm you use, majority of the use case or the classification in the smaller trees, or it could be an average. So it depends. But bagging algorithm is always a good solution for overfitting. And I've listed here some more applications like examples of statistical modeling. So for a credit card portfolio, you can predict what is the likelihood of the customer would reach 90 days or worse in the first 24 months or 2 years after booking a card, right? So if you have that prediction, then you can decide to approve or reject the application. And you can also decide on the amount of credit. Sometimes you want to give a customer like $5,000 credit limit on their credit card. For some customers, it could be higher. Then for a line of credit, once it reaches the end of the year, you typically charge an annual fee, and then you decide if that line should be extended for 1 more year. So you could build a model to predict the likelihood that if you do extend this line, will the customer go to 30+ day delinquency in the next 1 year? Then you could build a model to see how the credit score is dropping, right? If there's an adverse trending in credit score and other behavior for a line of credit, so you can take action ahead of time. As I said before, like typically when a customer is going to go bad, let's say they will try to max out their credit cards, take out as much as possible. So you can have a model to predict that. Okay, it looks, because the credit bureau is basically capturing all the information. What the credit bureau does is they actually collect information from all the financial companies or banks that the customer has relationship with. And those companies report on the delinquencies to the credit bureau. So if you look at the credit bureau data, then you would have an idea of, okay, the customer is actually performing poorly in all the other products that he carries with other companies. So we have to set up an alert for this person. Then, as I said before, if you send out a direct mail checking offer, how likely are they to respond to it? Because direct mail checking is an expensive proposition, right? You have to have manpower to deploy it, the printing costs, the mailing costs. So you need to have a decent amount of response, percentage of customers responding. So you can predict that too. And then this overdraft amount is sometimes, let's say, your for some reason your checking account, the balance reaches 0, and you give a check to someone without realizing that. So you give a check for like $1,000, but there's no balance in your checking account. So it goes into something called an overdraft. So the bank actually satisfies, the bank will actually give the $1,000. But then what if that overdraft amount will change to a charge off, right? What if the customer does not really have the money and you lose $1,000? So you can actually predict that ahead of time. And here are some decision tree applications. So you can, let's say you have a customer with product A, right? You have a portfolio of customers. We can build rules basically to identify the profitable or good customers in that portfolio, and you can apply their profile or these rules to existing customers who do not have their product. So you're basically cross-selling and saying that, okay, you do not have this product A, but you fit the profile of a customer who will not default or who will be profitable. So we are offering this product to you. So you can use it to cross-sell. And then you're looking at customers who use their lines a lot, right? High usage on their line of credit. And you apply their profile to people who are not utilizing and say that, why don't you use your line of credit? Here's an incentive for you to use your line of credit and things like that. You can understand the persona of your customer, right? How do let's say you have different kinds of credit cards, gold credit card versus a platinum card or a silver card. Or, you can use any other naming convention, but you can compare the profiles of your customers. What does a typical platinum card customer look like versus a gold card customer? And the reason you do it is, let's say you have a customer walking to the branch and they fit the profile of a gold credit card customer. You can say that, you know what, we offer this gold credit card, would you be interested? So things like that. So you can use decision trees to do analysis like that. And the last slide is, I just wanted to touch upon the languages that are typically used, and it would be very, very important for all the students to be proficient with these languages. SQL, as I said, is like you cannot not have the SQL skills for business analytics because it's the most widely used. I mean, the tools where they implement SQLs might be different, but the language, definitely you have to have proficient SQL querying languages. And this is more not from a SQL data engineer perspective. This is more from the analytics, right? How do you query the data? How do you clean the data? How do you do some basic descriptive statistics using the data? Things like that. SAS is another programming language. You can always learn SAS outside of a company too, in R and Python and Tableau for visualization. So that is it for today. So hopefully the session was very, very informative to you and it's helpful in deciding to go into the banking world if you choose to. And please let me know if you have any more questions.